Okay, now we're going to get into our Financial 15. So let me just get my whiteboard together. And here we are. So this week's Financial 15, our financial planning segment, is age-based investing. And I shared with you at the beginning of the webinar, and if you're just joining us for this portion of the webinar, the Financial 15 portion of the webinar, what you just missed was about a half an hour of market commentary, some analyst reports, a review of what happened in the markets last week, and some information from the Ed Slack group. The Ed Slack group is a well-recognized expert group in the area of IRA distribution planning and assistance, and I'm fortunate enough to be part of Ed's Master Lead Advisor group. We're about 400 plus strong throughout the country, but not enough, folks. And I explained to you, and again, if you're just joining us for this Financial 15 segment, please hit the like, subscribe, and notification button, and so you won't miss any upcoming videos. But as I shared with you in the beginning, just like many of my topics, this came from a conversation with a potential client. So this fellow said to me, "I just don't know. I don't know if I don't know if I'm invested the right way." And what's common we hear is, "I don't have a plan. I need help with a plan, and I don't know if I'm invested the right way. Am I too conservative? Am I too aggressive? How should it be split up?" So let's start with age-based investing. What is age-based investing? Because it's different than life cycle investing. So age-based investing is, I'm 55 years old. I want to retire in 15 years. So I go out and I say, okay, what if I want to retire? Well, let's not use that age because that doesn't work with my. If I want to retire in 2035, I can go out and I can buy a fund that has a target date of 2035. That's one method of age-based investing. It's choosing your investment allocation based on your age. Now, there's some problems with that. There's some rules of thumb that you'll hear out there. And the first one is the 100 rule of thumb. And they say subtract your age from 100, and that's the type of allocation you should have in your stock and bond portfolio. So if you're 60 years old, you would subtract 60, and they're telling you that you should have a 60% bond portfolio and a 40% stock portfolio. So that may be well and good. And obviously, if you're 70, it should be 70-30 bonds to stocks. That might be well and good for what you need, but it's really a very unscientific way of figuring out what's best for you. And it also leads itself to a lot of issues. How often do you adjust that? Do you adjust it by decade? Do you adjust it every 5 years? Because it shouldn't really be static if it's age-based portfolio, right? Do you go every year and change it? Now it's a 61-39 and a 62-38. How often should you review that? So that's not something that's really discussed in the theory. Overall, they talk about adjusting it over time, but really at what intervals? It would probably make sense just from a logical point of view to adjust it every 5 years. But you have to take into account other things that might affect the portfolio. So the first thing is, what's your acceptance for risk? Forget about the age and some simple, I almost said silly, but I'll just say simple rule of thumb. And the issue with these rules of thumb, it's like the 4% rule. We talk about this. You hear about the 4% rule. If you don't withdraw more than 4% of your portfolio, then you're likely not to run out of money during your lifetime. Accept. And I don't follow that rule, and I don't suggest that you follow that rule. And I have a whole video about the 4% rule too. And here I go with my notes. I'm going to link my video about the 4% rule. But I have a whole video about the 4% rule, but I hear the 4% rule all the time, and you shouldn't follow the 4% rule. There's a lot going on social media right now about Dave Ramsey, who maybe you may have heard of, but I'm sorry here, I'm covering up my 4%. But Dave Ramsey is a really a personality on on the radio and now on YouTube, and he I'm just going to be honest with you. He gives kind of wacky financial advice sometimes, and he's talking about an 8% withdrawal rate and a 10% withdrawal rate, or a 10% earning rate and an 8% withdrawal rate, which can be really dangerous for people. And I really don't know where he's coming from with that, but 4% may be too high for you. It's all very, very individualized. So the danger of these rules of thumb, whether it's using the rule of 100, and I have 120 here because there's now a thought that people say, well, with longevity, maybe this should be the rule of 120. So subtract your age by your age by 120, and that's how you get your mix of stocks versus bonds. Well, that may not make sense either, depending on your situation, depending on your risk tolerance, and depending on your needs. And we're going to talk about that in a minute. But the reason that these rules of thumb are dangerous is because they really do a good job of sticking in your mind. And because this is what I hear, investor behavior is just so important. And that's why I opened up this conversation with it's so important. And I love the opportunity. I'm thankful for that opportunity to talk to you folks all the time on a weekly basis, or whenever you can check in, listen to the recordings, because these rules of thumb, these 4% rules and other kind of things that have been thrown out there, they stick in your mind, and they're easy. Well, geez, if I just subtract my age by 100 or 120, if you think you're going to have longer longevity, then I can choose a portfolio, and that'll be fine for me, and then adjust it periodically, hopefully, if you remember to adjust it periodically. Or you can choose a life cycle fund where you identify your risk tolerance. So, that's another thing. Scale 1 to 10 is often the risk scale, and people say, where do you fall on here? 1 being the most conservative, 10 being the most aggressive. Where do you fall on here? And if you fall in the middle, and let's say the middle is 50-50, well, geez, you could just choose a life cycle fund, and there's other names for it, but a kind of a risk appetite fund, commonly called life cycle fund. And that's where I feel comfortable, so that must be good for me. That's not necessarily the answer either. These are easier things, but you want to avoid these rules of thumb, and even something that is more dynamic than or more dynamic something that I'm going to use an example of a Vanguard fund. And again, I have nothing against Vanguard. I use them in our own portfolios. They're they can be very efficient. And that is not an offer or a suggestion to buy, sell, or hold a Vanguard fund at all. But I'm going to use this as an example, and you'll see some of the issues with it. So you've got to work through what is correct for you. And the danger is they're very popular in 401ks, 529 plans, etc. They're very easy to access on the internet, very easy to do on your own. A lot of financial advisors lean on this information. Well, hey, that sounds good to me. And people agree. People say, oh, yeah, I've heard that. You subtract your age by 100, and that's how we develop your portfolio, where I take this test, this risk analysis test, and I fall on here somewhere is my point, and a portfolio is developed off of that, and that is then maintained. Well, that doesn't always work either. And there's a lot of issues with that. So we've got to talk about these issues, and we got to talk about potential solutions. So now let's talk about the issues. All right, so now I'm going to slide over here, and I put together some things from the Vanguard website. And again, I really like Vanguard. That is not an offer or suggestion to buy, sell, or hold, or use Vanguard. This is an example, but they're a really good company, and I wanted to use them as an example. So let me read this product summary to you for this fund. This is the Vanguard 2035 fund. So I thought this was a good start because, if you're 60, that might be your time, or 58, or maybe even 70, who knows? That's the whole other part of it too when you're talking about age-based funds. Listen, folks, they're going to drag me out of here at retirement, right? I am certainly, earliest I plan on retiring is age 70. So why in the world would I want to invest based on my age at that point, when or at age 65, based on my age, when I may have 5 more years of retirement and I might be too conservative at age 65. So I hope that makes sense what I'm saying to you. But there's other built-in potential issues. So let me read this to you. So the product summary for Vanguard. The Vanguard Target Retirement Funds offer a diversified portfolio within a single fund. That's nice and easy, right? That adjusts its underlying asset mix over time. Hey, good. It's dynamic. It changes over time. The funds provide broad diversification while incrementally decreasing exposure to stocks and increasing exposure to bonds as each fund's target retirement date approaches. The funds continue to adjust for approximately 7 years after that date until their allocations match that of the target retirement income fund. We want to get to the target retirement income fund, Vanguard says, because that's where you're going to be drawing from those funds. Investors in the funds should be able to tolerate the risks that come from the volatility of the stock and the bond markets. You may wish to consider this fund if you're planning to retire between 2033 and 2037. I can't tell you how many people invest this way. They invest this way because it sounds good, because it sounds dynamic, it makes sense, and it's easy. You can just choose one fund, and this is all going to be done for you. So let's look at the makeup. So this is a 70, I wrote it here, 70% stock, 30% bond fund. Yes, that's right. And you'll see it consists of 4 Vanguard funds. The Vanguard, I'll make this a little larger so you can see. The Vanguard Total Stock Market Index Fund, Institutional Plus Shares. Vanguard Total International Stock Index Fund, Investor Shares. Vanguard Total Bond Market 2 Index Fund. And the Vanguard Total International Bond 2 Index Fund. Again, I don't know whether these are good funds or bad funds. I haven't looked at it, but that's the makeup of this fund. So it's what we call a fund of funds. Now, what they say is, and let's look at the risk. So over here, remember, they're using a 5-point scale risk. And this less risk over here on the left, more risk over here. And this is where this fits in. So more on the higher side. If you're listening just on, if you're listening on YouTube and you're not looking at the video, what I'm showing is a 4-point scale. And this would be from 1 to 5. And this fund falls at number 4. So that more of a risky, right? 70% stock, 30% bonds, more on the risky side. And then what they want us to get to is this target retirement income fund. So you can see that's made up of the Vanguard Total Bond Market 2 Index Fund. I'll make that a little larger again so you can see the funds. The Vanguard Total Stock Market Index Fund, Institutional Plus Shares. And by the way, I'm not sharing with you any inside information. This is on the Vanguard website. So I just Googled these funds this morning, and so you can look this up anyway, but I'm sharing with you what's on here. Second, the Vanguard Total Stock Market Index Fund, Institutional Plus Shares, and the Vanguard Short-Term Inflation Protected Securities Index Fund, Admiral Shares, Vanguard Total International Bond 2 Index Fund, and the Vanguard Total International Stock Index Fund, Investor Shares. So there is some stock, but it's 30% stock, 70% bonds. So that's their target retirement income. And remember, that's the target that they're getting to over time so that you continue, theoretically, so that you continue to have growth, but you've got some stability on the bond side.